Hi there, welcome to Kneppyinvests, another update to the US markets. And the reason I'm doing these videos is because I'm finding what's happening overseas and on the Australian markets quite intriguing. I did a video a few days ago in regards to how the bears are winning, but the bulls have roared back on the 24th of January, the trading day in the United States. A really interesting trading day. At one point in time, it looked like the bears had completely won because the NASDAQ was down as much as 5% at one point in the day, about 2 or 3 hours after opening. But the NASDAQ was not down for the day. In fact, the NASDAQ was up for the day. And so I found it really intriguing what's happening over there. And I'll show you the 1 minute chart, just like I did in the previous video, and also show you some commentary, some content from Twitter. And at this point in time, Twitter is by far my favorite social media platform. That seems to be where the most of the knowledgeable people are posting content, and really interesting content as well. You just have to be aware there is a bit of bias out there. So let's get stuck into it. But before we look at what happened on the US markets overnight, just let's go back a few days in history to see what was happening before or leading up to the 24th of January. I'm recording this bit of the video about, well, almost 6 hours after the first bit, because markets have now closed and the Aussie markets are down between about 2 and 3% today. So even though there was a massive rally on the American markets overnight, the bulls on the Australian markets have been absolutely demolished. Now, I'm not sure why this happened. It could be the investors are quite skittish in Australia. We do have Australia Day tomorrow, and they could be fearing what's going to happen on the American markets. It could be the futures are down on the American exchanges, or it could be because inflation numbers were supposed to come out today. I haven't had a look at those numbers, and that could be making investors in Australia skittish as well, because if they were higher than expected, interest rates might be rising a little bit earlier than the Reserve Bank has been telling us. So even though people say we follow the American markets, sometimes we don't. And today is a perfect example. I did expect a rally in the Australian markets. I did expect us to be up, and I thought I would be selling some of my companies today. That did not happen. Last time I did a video was around about the 21st of January, and we did see 3 trading days on the United States markets, and the 3 major indices were all down fairly big during those 3 days. So the markets were definitely becoming oversold. In fact, the NASDAQ had fallen by about 12 to 14% since the high back in November of last year, where it did reach about 1,680. So a fair bit of bearishness had crept into the markets at this point in time. So this is just the daily chart. But when you look at the 1 minute chart, you actually get a little bit of a different perspective, because what happens during trading during the whole day is actually very intriguing, in my opinion, and actually can tell you a lot about sentiment in the retail end of the market and also institutional end. So let's have a peek at the 1 minute data up until the end of trading on January the 20th. And what was happening at this point, and there is an adage that says amateurs open the market, which is the retailers, and professionals close the market, which is the institutional investors. And what was happening, the market were opening up higher. So that's the buy the dip retail investors who had seen the market down the previous day and thought now's a good time to buy the dip. But it was fairly weak buying the dip, so I'm not sure what was happening, and it was really weak. And as soon as the institutional investors saw that weakness, they started selling. And that's why on the 19th of January and also the 20th of January, we saw major shift in sentiment during the day from slightly positive because of retail investors to highly negative because of continual selling by institutional investors. And in fact, on January the 20th, the market was up 2% after 90 minutes of trading, and by the end of trading on that day, it was actually down 1.3%. So that was a 3.3% swing in trading on this particular day. And then the negative sentiment continued into trading on the last day of the trading week, January 21, And there was a little bit of a rise near open, not quite on open, and that was showing you that these buy the dip mentality was growing weaker. And then we saw selling during the rest of the day. In fact, NASDAQ was down 2.75% on this day. Not as much volatility as we had seen the previous 2 days. And then as we went into the new trading week, and this is on January the 24th, we had a complete flip to what had been happening the previous day. And in fact, the market opened down by a fair bit, and we saw consistent selling during the first 2 to 3 hours of trading. So this buy the dip mentality from retail investors had turned into fear, and there was a lot of selling by the amateurs, by the retail investors. And this was not surprising because on Twitter, I saw a lot of negativity out there. In fact, I saw some posts referring to the possibility of the Monday, the 24th of January, being another Black Monday. So I think the selling we saw from retail investors on the Monday, the 24th of January, was that fear rearing its ugly head. But as we moved into the second half of the trading, we saw a complete flip to what we've been seeing in previous days. So retail investors were selling, and we saw institutional investors, because the markets were completely oversold at this point, found the opportunity to buy into the markets. You could say maybe this is going to be a dead cat bounce, but they just saw a bit of an opportunity to take advantage of the selling by retail investors and start buying. And we saw the NASDAQ rally amazingly in the second half of trading on this day. And instead of being down by a significant amount, it actually finished higher at the end of trading. So let's have a look at trading on this particular day. So I've just zoomed here on, this is still the 1 minute data, and this is the complete trading on January the 24th, and I've just included the last few minutes of trading on January the 21st. On January the 21st, the NASDAQ closed at 1443.84, and because of this fear within the retail investors, we saw the NASDAQ drop all the way down to 13,724.85. It took 3 hours for the NASDAQ to drop 5%. In fact, it was 4.9%, but we'll round that up to 5%. But then the retail investors saw their opportunity, and during the rest of trading on the 24th, the NASDAQ climbed high. There was a little bit of a blip about 2 hours after we saw the NASDAQ started to climb, but that blip was just a very short blip, maybe about an hour long, and by close of trading, the NASDAQ was actually up from the previous day by 0.5%. So there was a 5.5% swing in the NASDAQ on this particular day. And it's not historic, but you don't see this sort of swing very often. And it might be saying something to all of us. And I'll be talking about that when we look at the commentary from Twitter. Now, I've just zoomed in on the daily NASDAQ here. And the reason I've zoomed in here is there is 2 very similar daily candlesticks we have seen in the past 2 weeks. And that was the 10th of January and the 24th of January. On both days, the NASDAQ was down a lot at the low, and then there was a lot of buying came in during trading, during the last few hours, and in fact the NASDAQ rose by the end of trading. And on the 10th of January, we saw that momentum continue for the next few days before it failed, and then the following about 7 to 8 trading days, the NASDAQ fell by a lot. So this does give us a lead to the possibility that NASDAQ will rally over the next few trading days. You might call it a dead cat bounce, but the NASDAQ is oversold, so it wasn't surprising that we did see the NASDAQ rise on this day. And it's not even surprising we saw the NASDAQ rally halfway or from halfway in the day. The question is, what's going to happen over the next few days? I am still fairly bearish about the overall markets, the American markets, the Australian markets, and any rally I do see is a selling opportunity. Now onto some content from Twitter that I did find fascinating. This is from Jim Bianco. Now, he looked at the S&P 500, and at one point today, the S&P 500 was down about 4%. And he looked through history, and the only other time when the S&P was down by more than 3.9% and then rallied, it actually only happened twice before, on October 16, 2008 and October 23, 2008. On both of those days, the S&P was down by more than 4% and actually closed up 4% on October 16 and then up 1.3% on October 23. So for those who don't remember history, that was around the time where there was a heaps of volatility in the market during the GFC, and the markets would continue to fall from there for another 6 months. In fact, he mentioned this in his next point. He actually said wild volatility like this tends to happen in a bear market, not a bull market. That's absolutely true. The only example of this kind of trading before today was October 2008, and it fell another 28% up until March 2009, which was the bottom in that particular bear market. I'm not sure why Jim Bianco used a 3.99% cutoff for the S&P, because if he had a 4% it was a 3.9% cutoff. If he had a 4% cutoff, that would have filtered out what happened on January 24. And if you use a 3.5% cutoff or even a 3% cutoff, would his point be less relevant? So it's just interesting that he used a 3.9% cutoff. That's really interesting, and I think that's probably because he's a little bit biased and he wants to tell us that these sort of instances only happens in bear markets and the markets are going to fall. So wouldn't be surprised to see if that Jim Bianco is a perma bear or something like that. So here's another tweet from Charlie Bilello, and he noted all the days of the S&P 500 going back to 1962 where it rallied a fair bit during the day. And the lowest rally here was 4.3% back in 2002 and 2003. And the biggest intraday rallies actually happened in 2008 in October, November. And those two intraday rallies were 11.3%. And Charlie just mentions here most, but not all, have occurred either during bear markets or shortly after bear market lows. So does this mean we're in a bear market right now? Well, I think possibly we're at the start of a bear market. We're definitely not in a bear market low because the NASDAQ has only fallen 10 to 14%, something like that. So you can't say we're in a bear market right now. And the question is, how many times has this happened near the start of a bear market? I'd love to see that information, and perhaps this is the first time. Of course, we don't know if we're in a bear market just yet. We need a bit more time before we can actually confirm that. This is from Brent Donnelly, and this is about the NASDAQ. Today, the NASDAQ reversed more than 4%. In fact, it was 5.5%. And here are the other times that happened, and then the forward returns over a set amount of days. And this is actually really interesting because what we've seen so far in the other two tweets was just about what happened today compared to previous days. But then, in those days we saw in the past, what then happened over the next 5, 10, 20 days of trading. So this Brett Donnelly has broken that down to about 15 days in the past where we saw the NASDAQ reverse 4% intraday. And this is looking at 1 day period, 3, 5, 10, and 20. And what this is telling me is there is potential for a 1 to 5 day rally in the NASDAQ. If you go 5 days, the average is 0.1% and the median 0.5%. But if you go to 10 to 20 days, more than likely the NASDAQ will fall from here. And over the next 20 days, the average is 3.7% drop and the median is 2.5% drop. And then if you look at these amount of times this has actually happened, a couple of times over a 20-day period, the NASDAQ has rallied 18%. This happened in 2000 during the tech bubble bursting, and also on the 19th of March, where over the next 20 days, the NASDAQ rallied 18%. And that coincides with massive stimulus by governments, and that's why the NASDAQ rallied there. Other times we've seen the NASDAQ fall by as much as 20%, 2008, 19% in 2001 during the tech bubble burst, and 15% in 2000 and 2002. So more than likely, based off probability and mathematics, the NASDAQ will fall over the next 20 days, but it might be a little bit of a rally over the next 3 to 5. Now I thought with this intraday rally in the American markets, that would translate to the Australian markets, and it has not. I am quite amazed that the XJO is down 1.88%. This was taken about 90 minutes after the market has opened. I expected a rally today, and I was going to use that rally to increase my cash holdings, sell out of some companies, because right now I do think it's a sell the rally sort of situation, not buy the dip. I have heard from some professionals who say, I'm still remaining 100% invested. In fact, they're buying. And I actually did buy a couple of companies yesterday, Revisum and another company, just because some good news from those companies, and the market is liking those companies. But I am trying to sell some companies to increase my cash holdings, and if the market continues to fall, I'll increase my cash holdings further. I won't fully go to cash. I want to be 100% cash, but I don't want to be 100% invested at this point in time, because it's all about mitigating risk. And right now, there's a lot of risk that the markets might fall from here. It doesn't guarantee the markets will fall from here, but the chances, the probability is much higher than what we've been seeing over the past few months. Definitely, if you go back 6 months ago, the chances the markets were going to fall were quite low. Now, it's quite high. So I'm all about mitigating risk, using probability, using mathematics to protect your capital. That's all I have for this video. I actually had to retake this because I said the Raws bulled back. That's sort of like a spoonerism. I do have that little thing where I would say the rules board back, that sort of thing. That's a spoonerism, but sometimes I will flip words around and say Raws bull back. Anyway, the Bulls roar back in the United States, but the Bears are still winning in the Australian markets. Really intriguing to see what's going to happen overnight on the American markets, because tomorrow is Australia Day in Australia, of course, and there's no trading. So maybe the reason why the Australian markets are down today is they are concerned that this rally in America will be very short term, and by the time we go back to trading on the 27th, the American markets might be down a fair bit. So this could be just a lot of investors, again, just mitigating their risk, and they don't want to be in high-risk assets at this point in time. If you do have any questions right now, leave in the comment section of this video. Otherwise, that's it for this video. And last thing I should say, I'm not a financial advisor. So even though I've told you what I do in these sort of situations, you don't have to follow what I do. Find what's comfortable or what strategy is comfortable for you and try to stick to that. So maybe that sort of strategy will help you sleep at night. I sleep absolutely fantastic every single night. I don't stay awake fearing about what's happening on the Australian markets, the overseas markets. So my strategy fits into my own personality. And it's all about finding what strategy suits you. Anyway, I'm not a financial advisor. If you do need financial advice, make sure you seek out someone who is qualified and can speak to your own financial needs. That's it for this video. Have a good day. Bye.